I am looking at the performance summary for the Stock Index Portfolio 26, commenting out all long trades. The fastest way to test this was in Multicharts. I opened up each script, commented out the short trade, so not the long trades. This is long only, trading long only strategies in a bear market. You know, it's questionable whether we're in a bear market or a repricing based on the nature of this market. So short day trades should work in a bear market, but we go with what the market gives us, and right now what we're seeing is long only strategies still work best in this market. This is a test back to June of 2021, so a little over a year and 3 months. I really wanted to see a year, and I gave it an extra 3 months for calculating the data. That sometimes you need a month or 2 or 3 to calculate the strategy results. So this is about a year-long back test. And you can see the worst case drawdown was a little steeper in our original portfolio with longs and shorts. The worst case drawdown was around 30,000. In this setup, it is 30,000. Where is that number? 30. Here it is, 37,747 is max portfolio close to close trade drawdown. So this is on a closed trade drawdown. These equity curves are based on an end of trade, and so you could potentially have open, if you have longs and shorts, your shorts got stopped out, but you have open long positions, your real-time equity curve may not be that low. This would be a worst case scenario potentially. This is max portfolio drawdown at 41,587.50. So I think that's intra-bar maybe. But you see that number right there. Typically we look at end of day worst case drawdown. That's how we have it set up in the portfolio calculator for practical purposes of being able to actually run those calculations instead of intra-bar. And so let's look at the trade analysis. This is, once again, this is long only, commenting out in the script all the short trades. So 2,451 trades, $243 average trade profit. So over the past year, the index levels are higher, the daily dollar ranges are higher, the average trade profits are higher. So this is positive, even though, you know, the last, let's see, what time frame is this? This goes by trade number down here, not date. And so look at this trade number from trade number here, you know, about the last month or two. It's not making new equity peaks, but it's also not making a worst case drawdown. The drawdowns are very cyclical. And what I want to do next is I want to go back and run a longer back test. But if you're looking in the short term, we've talked about long only. If I were to do a long only test in my portfolio calculator, I have to go in and change all strategies, comment them out, and then reload all the data into the portfolio calculator. It'd be a very laborious process. This is a faster process, and so I want to load more data in my portfolio calculator. Here is what the Multicharts Portfolio Calculator looks like. I'm going back to 2011 now, and it's our strategies are more relevant from mid 2011 forward. And so you have to think about regime changes too. One of the things I've thought about are regime changes. Huge difference in algorithmic trading, and I want to make another video on that. So I'm going to run this back test and make another video on regime changes and my thoughts on regime changes and why test over certain time periods. To get this back test started, we simply click on back testing, and there it goes. We will wait for it to back test. It has to load the data, then it tests the data. So I will have another video for that. So here is the long only test going back to 2011, and I'm a little bit surprised. I hadn't taken a look at this in advance. I'm doing this in real time and then making the video, and I really love the cyclical nature. Really good results just trading the long only side. Let's look at the performance summary. The worst max portfolio drawdown is 46K. Max portfolio close to close drawdown is 45K, and so this is higher than our original strategy with short trades of 30K, but that worst case drawdown has gone to 60, right around 60K. So that has increased to 60K with short trades. And so long trades are still more stable. They've held up in this portfolio, even in what feels like a bear market, downward price action, these bounce backs tend to favor the long side. So, and they hurt the short side. This continuous dip buying liquidity, and so that could change. Such that the short trades do better and the long trades don't. But I wanted to take a look at the potential scenario of trading long-only strategies while we have a bigger drawdown. It's very consistent and more cyclical. It can be scaled. Let's look at the average trade profit on this as well. Look at the trade analysis, about 245, I believe, on the last. We go back and we look at it, $78. So it drops off. These include $25 round turn slippage and commission. Now keep in mind, we are gearing this towards the current market environment. And again, this really ties in with regime changes. As index values go higher, and the average, like a 1% move on a market that's at, say, $10,000 a Dow. If the Dow is at 10,000, a 1% move is 100 points. If the Dow is at 30,000, a 1% move is 300 points. So the daily dollar range goes up, and a lot of times there's a lot of psychology based on the point values in the market that you can take advantage of, and so that's something that we also look at in our strategy design. But very consistent, not a worst case drawdown in this current market. The worst case drawdown is back here in this current market environment. The worst case drawdown on long only trades is really held up. You can see the equity curve as it accelerates. Index values are also higher. It's kind of flat right here. There are time periods when it's flat. Time periods when this equity curve goes flat, and so could break out. Could be a good trade. Good trading the long side, even in a bear market. Even if this bear market continues, there's always bear markets, and these are day trades, so they may not. A day trade will not necessarily take many long trades on a strong sell-off day. So if the market's selling off on the day, it's not like we're loading up and getting killed on the long side. So wanted to share that with you. I'm going to make another video on this, so this will be redundant, but a brief view on regime changes, and to put this in perspective of how far back to test. 1997. Here's an example. These are related to futures contract changes. Did these cause regime change or predict regime changes or market changes? So the big S&P traded in the pit. It was $500 a point. That market was traded in much narrower ranges, but a 1-point move was $500. It traded in 0.1 increments. The mini trades in 0.25, and it's $50 a micro. Is $50 on the mini in 0.25 increments, and it's $5 in the micro. And so in 1997, the big S&P split from $500 to $250, and you see the equity curve of the S&P accelerate on that. Exponential over time on a linear chart, instead of a log chart, also shows that acceleration. And so. But what happened in 1998? There's some hedge fund blowups, currency crisis. 2001, there was a dot-com bubble, and then we come back. The market resumed its bull market mode from 2003 to 2006, and between 2006 to 2008, all futures markets. So the S&P started trading electronically in 1997, but a lot of these other markets did not trade electronically until 2006 to 2008, and a lot of the ICE markets started trading in 2008. A lot of the NYMEX and COMEX and CBOT started trading, around September, August of 2006, and so it moved to electronic trading. To me, markets trade differently now in the electronic markets, and they're at higher index levels, and so to me, this is a regime change. And so then we had the 2008 financial crisis, and then we've also had QE. QE has really biased the market. So one thing you have to consider is, since 2008, 2009, we've had QE. This should be a 0. 2009 there's been QE and electronic market. So should you even test before 2009 in a longer term basis? Here's another example of a futures market that's added. Does it change? Does it cause the market to change? Or is it predictive of an upcoming change in that market? For example, Bitcoin futures were added in 2017. I believe Bitcoin made a high of around 17K in 2017, and then it went to a pretty strong bear market when the futures were added. And I had considered this scenario: will the creation of this futures cause this bear market because it allows short sellers to come into the market on the futures? The futures were not that liquid, but you still have to take a look at potentially what this causes. In 2019, I'm going to erase this now because it's making a mess. So in 2019, we see micro futures were added, and you see just more vibrations in the market. So a market that might move like this, now kind of moves like this. You have to know if it's arbitrage between the micros and the minis. But we had the pandemic as well, and we have higher index, we had Fed stimulus, so it's hard to know. But it's interesting how when micros or markets, new futures markets are added, such as micros or e-minis or point value splits or going electronic, does it change? Does it change the market? Does it anticipate the market to change, allowing hedgers saying, hey, we need to add this contract so we can hedge, we see something coming? Or does it cause it? Very interesting idea to play with. I'm not saying that it does or doesn't, but we had the micro futures, we had the 2020 pandemic, massive Fed stimulus, different form of QE, and now we're at higher index levels than we've ever been. It's hard to look at a lot of our strategies work back to, say, 2017 or 2016 or even 2011, but most of their profits are from 2020 forward. I mean, the market just ramps, the daily dollar ranges ramp, and so you really want to, patterns change too. So you have to find a bias in the market, and those biases changes with regime changes. And so something that worked 2001 through 2005, the opposite might work. The exact opposite. I've seen something work really well, and then for whatever reason, you take the exact same pattern and flip it in the future, that exact opposite pattern works. And so regime changes happen, markets change, so you have to take that into consideration. When you look at these equity curves, the main point I want to make is this equity curve here, it just accelerates as these regime changes and index values rise. And so I'll make a separate video for the regime changes. Wanted to add that to this video to put a framework in for what we're doing and why the average trade profit increases. So that's what I wanted to share with you on this Friday, the last day of the month and last day of Q3, as we are adjusting our portfolio setups. Hey, David Bean here. Welcome to Capstone Trading Systems YouTube page. Be sure to subscribe to join our community of algorithmic traders. We are real money traders. We share our winning streaks, we share our losing streaks, as well as market updates, strategies, and coding tips.